Welcome, everyone. My name is Leslie Griffin, and I am a co-founder of Women in World Trade New England. We are pleased to welcome everyone this afternoon for a conversation with Lori Heinel, Executive Vice President and Global Chief Investment Officer of State Street Global Advisors. In a moment, I will introduce today's moderator, but first, just two brief housekeeping notes from me. So first, our next virtual event will be on Friday, May 21st at 4 p.m. And for the first time, we will not have a speaker or a formal program. In response to suggestions from a number of you, we plan to have a purely social networking hour. And we look forward to a chance to get better acquainted with each other and share news and ideas. So please watch for registration details, and we hope many of you will join us. Second, we recently sent out a member survey, and we want to thank those of you who have completed it. As we proceed with our second year since reviving Women in World Trade, we want to be sure that we are being responsive to you in terms of the kinds of programs we offer, when we offer them, and just what you hope to get out of the group more broadly. So our communications coordinator, Bay Tipping, is putting more information about the survey in the chat right now, and we would certainly appreciate it if you would invest the 2 to 3 minutes that it will take to complete it. Without further ado, we'll get started with today's program on how trade dynamics and geopolitics affect the 2021 economic outlook. Leading the conversation with Lori Heinel today will be Christa Bleyleben, the founder and managing partner of MassGlobal Partners, which is an international strategy firm that helps innovative companies to internationalize their businesses. As many of you know, Christa was executive director at the Massachusetts Office of International Trade and Investment, or MOIT, and was also president of the Massachusetts International Trade Council. Previously, Christa was a managing director at Bank of America Securities, with responsibility to manage the bank's relationships with the world's top 250 financial institutions. So let me now turn it over to Christa.
Well, thank you very much, Leslie, and thank you very much for the very kind introduction. And thank you to Women in World Trade for organizing this event. So I'm delighted to be here with Lori Heinel. And Lori, thank you so much for making time available to join us.
Yeah, my pleasure.
Great. So by way of a brief introduction, Lori is Executive Vice President and the Global Chief Investment Officer of State Street Global Advisors, which is, I believe, the 4th largest asset manager in the world.
Actually, the 3rd.
The 3rd. I'm sorry. I'm
Indeed.
3rd largest asset manager now. Wow. And you're managing like $3.5 trillion dollars under management, which is quite a number. Mm-hmm. And in her capacity, Lori is overseeing all investment capabilities from index and exchange traded funds to multi-asset class solutions and alternative investments. And she leads a team of more than 600 professionals. Is that correct?
Yes, that's correct.
And she's also a member of the company's executive management group, investment committee, and the global product committee. And prior to joining State Street Global Advisors in 2014, Lori held senior positions at Oppenheimer Funds, Citi Private Bank, SCI Investments, as well as Mellon Financial and Parker Hunter. And she started her career at Credit Suisse First Boston. She has an MBA from Carnegie Mellon and a bachelor from Princeton University. And she also has a CFA designation. So it's really a totally impressive resume. So, and I think it's actually also quite fitting that we have this conversation today, because April is Financial Literacy Month, I believe, right?
Mm-hmm. Yes.
So before we start, I wanted to also recognize that we have a lot of international an audience from overseas. People have registered from as far away as South Africa, Kenya, Saudi Arabia, and Algiers. So I want to extend a very special welcome to our international audience. So as Leslie already mentioned, please, we'd love to have your questions. So use the chat function, and I will try to do my best to monitor the chat function. So before we start, I would like to thank, so Laurie, can you give us an overview of State Street Global Advisors, clients you serve, products you serve, and specifically tell us a little bit about your role.
Yes, absolutely. And again, thank you so much for having me, and welcome to everybody who's joining us today from literally all over the globe. That's really exciting to see. So as you mentioned, we manage over $3.5 trillion with a T, so very large franchise globally. We cover all segments of the marketplace. So we cover global institutional players such as defined benefit plans and sovereign wealth funds and corporations. We also tap the retail market through intermediaries, primarily distributing through RIAs and broker dealers, but also 401k plans. So certainly plan sponsors are one of our target audiences as well. So we're literally global, and we cover pretty much every segment of the market. And we actually do that through a variety of capabilities. We're probably best known for our SPIDER franchise, our ETFs, and our indexing capabilities more broadly. But we do have several hundred billions of dollars in actively managed strategies as well across fundamental and quantitative processes in both fixed income as well as equity. So we care a lot about the issues that we'll be talking about today. Certainly global trade flows, macroeconomics, policymaking, all of those are things that we watch very keenly, both through the lens of how do we make good investment decisions for our clients, but also as an organization that operates on a global basis.
Mm-hmm. Great. And your specific role?
Yes, I did forget that. So yes, as you mentioned, Global Chief Investment Officer. So as you noted, I'm responsible for our footprint of about 600 investment professionals globally who are doing everything from research, portfolio management, trading, execution, meeting with clients, product strategy. So there's a whole complement of things that go into both the effective delivery of our investment capabilities to our clients, as well as all the operational infrastructure that supports that.
I guess you really keeps you really busy.
Indeed.
So I'm really curious to looking at the markets, and I'm watching CNBC as many of us do. The market is performing extremely well, certainly compared to a year ago. And thinking about what we have been through in the last year, I mean, last March we had, an abrupt drop, of course, in the markets, and now we are close to all-time highs. So what do you think is the current driver? What is the market's strength? Is it looking forward, or give us your take? Do you, without holding you to any answers, do you think this will continue?
Yeah, look, I think we're seeing the confluence of a variety of factors playing through in market performance over the course of the last several months. First and foremost, while we're clearly not out of the woods as it relates to the pandemic, and there are hotspots, notably, India, more recently, Brazil, some other parts of the world that are really still in the very darkest depths of fighting this pandemic. If you look at it from a broad-based global standpoint, there are green shoots. Certainly here in the United States, we have started to vaccinate, people with, great results there, and gotten some of that under control. And I think just generically around the globe, there's this sense that we can move beyond the very draconian kind of lockdowns and other suffocators of economic activity that we had to deal with in 2020. So, the market's sort of a forward-looking indicator. It's looking for that revitalization of economic growth. And I think most of you would have seen that the International Monetary Fund actually upgraded performance of the global economy, and that certainly is buoying risk assets. But we've also seen a rotation from the very narrow parts of the market that had done pretty well even during the depths of the crisis, where there were high growth opportunities, mostly technology focused kinds of stocks, to now a much broader set of equities that are participating in a more cyclical kind of a recovery. And then finally, when you juxtapose equity kind of forward earnings prospects against things like the current interest rate environment, which continues to be incredibly low, relative valuations, while frothy, certainly don't seem to be at a point where they will collapse of their own weight.
Yeah. So I think it clearly looks that, we are ahead of Europe when it comes to vaccinations. And I think you referred the IMF. I saw just, I guess yesterday, I think their expectations that the US will, grow, close to, like what, 6% or so. I mean, pretty impressive growth targets. So do you think what specific regions or sectors are best or least positioned, if you will, to benefit from, from this recovery after COVID?
Yeah, so I think if you look at the regions, we're favoring those places where the trajectory is a bit more clear. And again, not that anything in investing is always completely clear, but if you look at the US, for example, as you note, the likely economic recovery will be quite dramatic. And, as you mentioned, most prognosticators see it coming in the high 5s or low 6s. We're a little below that, mostly because we think that the recovery in the US will elongate into 2022. So we're a bit behind consensus for 21 and a bit ahead of consensus for 22. But suffice it to say that the US still looks pretty well positioned relative to many other parts of the world. The other market that we've been quite positive on is China, and they're again driven in part because of the way that they were able to manage through the pandemic and the ability to continue to kind of fuel growth and benefit from some of the broader regional dynamics related to the pandemic and how the region as a whole was able to respond to some of those pressures. We've been much more sanguine on Europe, and again, as you know, the European experience has been a bit more lumpy. Certainly there are green shoots there. The UK seems to be finally getting its footing, but the broader European complex continues to be a bit behind the curve. So broadly speaking, constructive on equities, favored regions being US, Asia, again, notably China, and then being a little bit more cautious on Europe. When we look at sectors or industries, again, we've been a little bit barbelled. We've continued to maintain allocations to some of the technology companies and healthcare and some of the other sort of higher valued parts of the market, in part because those are transformational. So we've tended to not chase the frothiest parts of those industries and those sectors, but we still are seeing pretty good value and want to participate in the innovation thesis that underpins that. But at the other end of the spectrum, we've seen a lot of attractive valuation in more cyclical sectors. So coming into this year, looking at financials, looking at consumer durables, looking at materials, and the commodities complex was another place where we've started to deploy capital. So pro-cyclical, and as you note, focused on those regions where we think we have a little bit more transparency to the economic trajectory.
Well, it's interesting. Your first thing you mentioned is China, and there's a lot of interest in China, obviously. I mean, it's such a huge market. But it seems quite obvious that China is really trying to assert its role and kind of position itself as not inferior, but rather at least at equal footing with the United States, if not, superior, if you will. So how do you think this relationship is going to evolve with China? I mean, we certainly, with the new administration in Washington, there's a lot of political back and forth. One of the questions everyone is asking, what are we going to do with the limitations and the tariffs that we have established with China? So how do you see this relationship evolving in the next so many years?
Yeah, so I think the first point is that we are now in what we characterize, and I think many have characterized as strategic rivalry, right? So your comment about China's aspiration to not only be an equal, but ultimately to be the preeminent global power is very well telegraphed across, many parts of, how they sort of engage with the rest of the world. So we don't think that the tensions between the US and China, for example, are going to go away. In fact, if anything, they're going to continue to become, even more acute than they've already been. And you can see that in everything from the sort of economic spheres of influence. If you think about innovation and patent generation, China's been quite ahead of the curve on that. If you think about some of the potential flashpoints from a military standpoint, there's likely to be, ongoing challenges as it relates to that. So we think that the notion of strategic rivalry is the right framework for thinking about a US-China kind of relationship. Having said that, I think there are a couple of things that are also very important. And one is, with the Biden administration, we don't think there's going to be a relaxation on any of the concerns about China or constraints or any of the other sorts of economic things that were put in place under the Trump administration. However, we think that complexity or that landscape is likely to be less volatile. So I think one of the things that we did see under the prior administration was appearance that certain kinds of agreements might get struck, and then deterioration in those conversations, and then all of a sudden there'd be tariffs or other kinds of reactions. Again, we don't think those things are going to go away, but likely to be less of a volatile kind of political and ultimately PR dynamic, right? So that we kind of know what we're dealing with. It's not necessarily constructive, but it's likely to be at least more predictable. And so we sort of like to think about the backdrop now as being less macro driven and much more micro driven. So it'll be the individual decisions that get made that will be much more important in this kind of broader strategic setting of the relationship. The other thing that I think is really important is that there is at least more opportunity for a more multilateral approach to China under the Biden administration. And again, for better or for worse, a lot of the Trump administration was much more unilateral, right? They would engage really based on what America's interests were. And whether you agree with that or disagree with that, the Biden administration seems more keen to engage in a way that's much more multilateral. So if you look at participation in things like the climate initiatives that we've already seen the administration roll out, or you look at some of the discussions around tax policy and kind of corporate tax policies, there are other ways to engage with that global community that are not just about trade, that can help create more of that multilateral dynamic so that you have a much more complete and holistic engagement with China, and the potential to maybe not isolate them, but try to keep them a bit more at the margins.
Yeah. So do you think China's going to test, I'm sure they will test the world, if you will, the United States specifically? I mean, we've seen already what's happening in Hong Kong. I dare to ask, what's going to happen with Taiwan? Do we have to be concerned? Are you concerned?
Look, I think that we have to be concerned for sure. I mean, every year we write a global market outlook, and we also write a kind of black swans or gray swans kind of an article. And every year a China policy misstep features large in those risks, right? And the reality, as you rightly note, is that there are many potential flashpoints. It could be the border with India. It could be Taiwan. It could be Australia. It could be Japan. It could be the US more directly, and at a minimum, challenging the sort of underpinnings of Western democracy and even things like basic human rights. It's sort of interesting to see the summit most recently and them calling out some of the racial disparities that we have in the US as something that was notable, right? So I think that this idea that China is going to just be quiet or shirking violent, that's long gone if it never existed in the first place. And the real question is, to what degree do they flex their muscles and exert sort of the means to influence, versus are there actually policy missteps and or more aggressive overt actions, which would then have to be responded to in a much more comprehensive and urgent way.
Yeah, so I guess sit tight and tighten your seatbelt, I guess. Yeah.
Indeed. No, let's make no mistake. They have a lot to lose, though, too, if they do make that strategic policy mistake, because there's not a lot of sympathy in a lot of parts of the Western world, or frankly, in parts of Asia for China's actions.
Yeah.
So to the degree that they overstep, that could create a pretty unified backlash. So they have to tread lightly as well. But again, anytime you have these this degree of ambition coupled with the means, coupled with the potential for overstepping at any moment in time, you have to be quite cautious.
Yeah, absolutely. So if we're looking at the trade policies more generally around the world, I mean, certainly you've already mentioned that the current administration, Biden, is taking a very different approach than the previous administration. How do you think the US will in general approach trade policies, and how will that influence international relationships in general?
Well, there are lots of different underlying factors, and the broad strokes are getting set through some of the macro agenda, right? So if you think about tax policy, part of what the Biden administration is talking about as it relates to tax policy is sort of a minimum tax, right? So increasing that and creating a more level playing field. And in one regard, you would argue that that should be positive for trade in the sense that it doesn't, overly advantage, companies that have different footprints that capitalize on the, the arbitrage, if you will, around tax policy. It also, if you look at climate and sort of the early entrees into climate, again, not related to trade per se, but I think the spirit of cooperation, understanding that the US is part of a global ecosystem and that there are shared bases for collaboration and cooperation. So if you kind of start with those kinds of backdrops, one could envisage less of these kind of tit for tat trade kind of negotiations and more comprehensive types of trade platforms. The other thing that I think is important is that there is this kind of other trend that supersedes anything that's administration or US based, and that's just the kind of evolution of globalization. And we actually did a fair amount of work a year and a half or 2 years ago now on the notion of deglobalization, because even before the pandemic hit, there were lots of forces that were in place to start to destabilize what had been a sort of onward march towards globalization across obviously the globe. And one of the things that we saw at that when we did that work was that the likelihood of having much more regionally focused alliances. I think North America and sort of the Americas writ large, or think about the APAC region, or think about Europe as a kind of cohort, both the emerging as well as the developed parts of Europe. And the winners in that environment tend to be some of the third parties that really got lost or didn't capitalize to nearly the same degree under a much more globalized free trade regime. So there are sort of gives and gets with this whole question of how the administration or how America writ large is going to engage in trade policies. But I think that we'll see a couple of things as kind of undercurrents. One will be deglobalization and maybe the rise of these more regional types of arrangements. The second will be a bit more protectionist sentiment generically, and again, I think that will be a function of the broader Democratic Party agenda. But also, there's a lot of Republican agenda that favors that kind of protectionism. And then, lastly, perhaps a more stable and consistent approach to the global taxation of corporations. Again, probably not at the level that's currently advocated on behalf of the Biden administration, but probably something that's a bit more than what we have today.
Okay. Are there any regions that you're specifically concerned about that you're, like, I don't know, Russia or Iran or there are flashpoints all the time, but
there are lots of them, and for all different reasons. I mean, I think, you can take the kind of short-term view, and you've got, still pandemic crisis in a lot of, economies like Brazil and increasingly India's, trying to get its arms around the most recent outbreak there. You've got Russia, which is a perennial, actor on the stage that can do things that are a bit destabilizing. Certainly many places within the Middle East, we talked about China earlier. So there are all manner of places that things can kind of come from left field, whether it's from a geopolitical or a terrorist kind of a problem. I think the other thing that's going to be really interesting to watch, and we saw a bit of this many years ago now when we had the Arab Spring, right? Where you had, Egypt at the time was sort of the epicenter of the uprising of younger generations who felt that they were sort of disenfranchised. I think you're going to see that kind of, whether you call it populism or you call it, this sort of demographic rise, however you want to look at it, I think that is a real concern. And if you look at whether it's income inequality or you look at places where young people are relatively disadvantaged, and then you juxtapose that against an environment where maybe their underlying economic wherewithal is being threatened. So oil producing nations where efforts against moving away from carbon and fossil fuels may stymie the overall economic picture. Those are the other kinds of things to be quite aware of, because they can lead to much more just deterioration, if you will, in the social contracts that guide a lot of the global trade and just sort of being a part of the global citizenry.
Yeah, absolutely. And so when we're looking at the global citizenry, I think the COVID crisis also exposed a lot of bottlenecks in the U.S. supply chain.
Yeah.
Certainly, we rely on the critical goods coming in from, if that's China or India or other locations. So looking back at, the scramble we had to deal with earlier, and especially and even now, like looking at batteries and we have Taiwan and South Korea controlling a lot of the chips manufacturing and so forth. Do you see a shift in reshoring and onshoring or of critical goods, or how do you see that play out?
Yeah, so I think every country and every company is evaluating its vulnerabilities vis-a-vis supply chain in the wake of this. And some of those vulnerabilities are, they're transient, right? So, it was hard to find toilet paper a year ago, and now we have a toilet paper glut, right? So some of those vulnerabilities come from hoarding activities or other poor planning, if you will. But some of them also come from lack of investment, lack of business confidence. So how you create policies that favor investing against, a backdrop which is much more uncertainty, and that's where things like tax policy can actually be constructive as it relates to creating those kinds of dynamics. But again, we've already seen the Biden administration leverage some of these concerns to undertake strategic reviews, right? And semiconductors being one of those where, the supply chain implications are much more far reaching than the average person would probably understand. And yet to kind of build out that kind of infrastructure is incredibly capital intensive. I mean, the numbers that are bandied about are a drop in the bucket relative to what it would take to truly achieve some sort of self-sufficiency there. So I think you have to kind of look at this through a couple lenses. One is, how do you make sure that you don't become over-indexed on a single supplier or a single jurisdiction? In some cases, there are precious metals or other kinds of inputs to the process that are by definition localized, and so it's more difficult you can't manufacture those, so you have to have some mechanism for negotiating and having the right kind of terms of trade. And then you ultimately have to have transmission mechanisms. So there again, the other bottlenecks that we saw during COVID that were a bit unique was the transmission problem. It wasn't that you couldn't manufacture them, you just couldn't get the things from the places where they were manufactured to the places that you needed them. Yeah.
Now, you mentioned tax policies a couple of times, and certainly that's a very powerful tool. So obviously we all hear that it's more likely than not that taxes will go up, and there are different types of taxes that may be increased, but certainly there's a lot of discussion about the corporate taxes. What do you think that is going to mean in relation to reshoring, onshoring, bringing stuff back to the United States? Is that a disincentive, or will companies rethink and go back and incorporate in whatever, Ireland, for example?
So it depends. So I think the first thing that we need to all just remember is that the current proposal is unlikely to be the final proposal, right? So this will be a very heated debate that will play out over likely many months and will probably look quite a bit different than currently configured. If, however, the current plan was implemented as designed, that would cost as much as 6 to 8% off of companies' net profits. So on the surface, at least, that would be quite a blow to, in the aggregate, US equity valuations, for example. So what's the bid ask, right? So the bid ask is 0 to 6 or 8%. Let's say we land somewhere there in the middle. The other thing that we know is likely to happen is that in addition to any kind of increase in the statutory rate, there's likely to also be all manner of carve-outs. So whether that be additional investment opportunities and how that tax treatment occurs, whether it be sort of international tax rate and sort of a minimum tax is something that's sort of being bandied about and how that plays through. Certainly the 21.5% that has been talked about is about double where we are today and would in some sense render US multinationals much more non-competitive relative to some of their non-US counterparts. So it's again unlikely, we don't think it's likely that it's at that level, but the fact that there's this conversation going on globally is actually quite interesting because many countries outside the US have been calling for this kind of minimum tax for quite a long time. So I think it's a little early to know all of the broad strokes, but if there are incentives for investment, then that could be a positive in terms of either reshoring or onshoring to the degree that there are incentives to have activities happen in a certain kind of location that will change behavior at the margin. But it's way too early to know exactly what this is going to look like because there's a lot of negotiation ahead. And even within the Democratic Party, there's not consensus in how far reaching it should ultimately be.
Yeah, it's certainly an interesting topic to watch. That would be quite a task to get a unified international sort of agreement for that. Yes. Yeah. Mm-hmm. So can we move a little bit a topic I'm really personally interested in, I hear also our audience interested is, what about ESG investments, like socially responsible investments? There's a lot of discussion on that. How do you view that? Is that an important topic for your clients? How is your portfolio looking at that? And where do you see we're going with that?
Well, first of all, it probably is the topic of the day, right? So virtually every client that we talk to globally has at least some interest in the ESG landscape and what it means and what it might mean for them. I guess the first thing I would say is this is not new, right? So socially responsible investing or some version of early ESG types of activities have been going on for literally decades. But what's new today is that the origination was largely more exclusionary or sort of values or socially based types of exclusion. So think about the faith organizations who wanted to eliminate things like contraceptives from their portfolios, or clients who wanted to eliminate the sin stocks, tobacco, things of that nature. Those were kind of the early days. We're way beyond that now. There's a growing body of academic and industry research that suggests that ESG considerations are foundational to long-term investment risk and long-term investment returns. And you can see that in a variety of studies that look at companies that manage their ESG risks better, perform better. Companies in a variety of areas, whether it be diversity or it be in kind of carbon management, they actually have less incidences of fraud or other kinds of reputational damage. And ultimately that distracts their management a lot less and they perform better. So the way we think about ESG writ large is we want to understand those ESG elements that are intrinsic to a corporation's operating model and material to their financial performance through time. And so across literally our entire book of business now in our conventional indexing portfolios our job is to track the benchmark. So if the benchmark is the S&P 500 or the Russell 1000, we track that. We hold every company in that benchmark. But beyond that, if we have clients who are interested in reducing the carbon footprint of their portfolio, what we found is that you can actually get pretty material reduction in carbon with very, very limited tracking risk. We've also found within our active portfolios that good quality companies who manage their ESG risks are overrepresented in many of our active portfolios because they have a better long-term risk return profile. So we try to look at it sort of investment philosophy by investment philosophy and integrate it appropriately, but we anchor very much on the value creation versus having it be more of a values or political statement.
And do you see a big difference between how the US is looking at ESG versus, let's say, Europe? In my experience, very often, I think Europe is a little bit ahead of us in that thinking, but I don't know how you see that.
No, Europe is definitely far ahead on the thinking. And in fact, to the degree that they've started to mandate disclosures and other kinds of reporting on some of these ESG considerations, in particular carbon. But the US has done a 180, so 6 months ago, the US was relatively silent. And if anything, you had the Department of Labor had issued guidance suggesting that for defined contribution plans, plan sponsors had to, really only take account of what they called the pecuniary or financial interests, which sort of implied that ESG interests didn't have financial or materiality or pecuniary impact, which we of course disagree with. Now you have, Secretary Kerry, very loud and vocal last week announcing the US's commitment to, looking at climate, engaging on these issues, and putting ESG very front and center on both the policy making as well as from an infrastructure and fiscal policy stance. So very different than we were. I would say, though, from a client standpoint, Europe is still far ahead of the curve. And these are issues that many of our large clients in Europe have been thinking about for a long time. They've already got integrated into their portfolio. They believe the science. They, again, are now working on things like reporting, disclosure, other parts of evidencing the journey. Here in the US, you do have some forward thinkers in many of the large public plans, for example, on the coasts, but from a wide sort of swath of America, that those still have not been primary considerations as they've thought about portfolios.
Yeah, interesting. Now, speaking of portfolios and different types of investments, there's a lot of discussion about NFTs at the moment and, non-fungible tokens. And don't ask me any specific details because I still struggle with totally getting this concept. But, you see people investing in, I don't know, from artworks, NFTs and artworks to sports cards and all sorts of, incredible different asset classes. What's your take on that?
Yeah. So first of all, while the acronyms might be new, NFTs, SPACs, cryptos, whatever, the concept is not new at all, right? So for probably millennia, people have looked for ways to, get rich quick, let's call it, right? And, look, our overarching view is that you want to think of investing as something that is a bit more predictable, although investing obviously has its own, journey, but where you can rest on historical relationships and fundamental analysis and other kinds of input to make some sort of informed thesis about the future path of an asset price, right? And when you look at a lot of these kind of new age, components, if you will, they still fall short in terms of having some of the primary attributes that you look at for an investment portfolio. They don't have, real price discovery. I mean, they may be traded basically by appointment. They may have sort of no intrinsic value. Some of these are valuable only because people place value on them. There's not like an actual intrinsic source of that value. They may not be, stable correlations with other things in the portfolio. I mean, you look at something like Bitcoin or cryptos, people talk about them like they're a currency. And in some sense, you could argue that they're an alternative to a store of value or a transmission mechanism, but they don't have stability in the relationships with other asset classes or even other currencies for that matter. So it's not to say that these investments or these components can never get there, but in their current form, they're much more like collectibles or tradables than they are investments.
I mean, certainly the volatility is just enormous, but you hear
enormous.
more and more saying this is the new gold, instead of having gold, let's have a cryptocurrency. And I don't personally just get that yet, but.
Well, I mean, the good and the bad, right, is that they trade off of momentum. They kind of create their own force. And so if you happen to be an individual who got into that kind of trade early by virtue of momentum, you probably make a lot of money. But at some point, then it turns. And again, if there's no intrinsic value, literally you can read reports that suggest that Bitcoin, just to take one example, may be worth hundreds of thousands of dollars, and you can look at other reports that suggest that it's worthless. And when you have, again, that's not that there aren't other investments that have that property. Certainly, some individual stocks do, but when you look at that wide range of potential outcomes, it's hard to think about it having a fundamental kind of intrinsic basis for valuation, at least at this stage.
Yeah. Okay, great. So just looking at a couple of questions here from the audience. The famous Brexit question.
Yeah.
How will Brexit affect the US-UK trade relationship? And that's going beyond the claw and chicken discussion. That was
yeah. Well, look, I think the good and the bad is it means that now you have a bilateral trade negotiation versus a one-to-many kind of a trade negotiation, right? So I think historically there have been lots of benefits that have accrued to the U.S. and the UK retaining strong relationships to the degree that it's in the U.S.'s best interest to trade with the UK. I think that there will be paths forward to make sure that that's as seamless as possible. But now it's one country versus a bloc, and so in some sense the heft is not there as it might have been as part of a bloc. But the other side of it is it gives them more autonomy. Obviously, that's what they voted for in terms of forging a path that makes sense for them.
So you think the UK is approaching how vis-a-vis Europe? Is it they're coming closer to the US again? I mean, there was some discussion that they don't want to be seen as the 51st state.
Yeah. No, look, I think they'll forge their own independent path, but there are lots of competing interests there. And even within the UK bloc, there are concerns about the Northern Ireland border, and there are concerns about the dislocation even within their sort of small footprint. So I think there are lots of competing interests. Ultimately their goal will be to try to negotiate good trade relations with whatever group of partners that they can trade with, right? Europe and the US being two of the main ones. But again, their negotiating power is not what it would have been as part of a larger bloc. But the difference is it's their negotiating power, not them as one voice among many.
Okay, great. Now I'm just trying to look, there's quite a number of questions. Can you speak to the challenges you've faced as a woman? That's a very good one. In finance, I mean, in a male-dominated, world. So, okay, I think I actually like that question. Yes. Any particular skills that helped you along the way?
Yeah. So, for better or for worse, I never felt the femaleness in general, right? So I grew up, I was raised in Western Pennsylvania. My dad was a coal miner, as it turns out. And I was the oldest of two girls. And so I was sort of the boy my dad never had. So from a very young age, I was sort of comfortable being in environments where men were the dominant party, right? So it would be go fishing or hunting or whatever. So I never really felt limited by my sex. Having said that, I can remember many times early in my career walking into a room of primarily men and being asked if I could get them a cup of coffee, or being called sweetie, or, doing the double, lip touch, or whatever it was. It was like, the cringeworthy moments of my youth, and those lasted well beyond my youth. So unfortunately, I think we've all experienced some of those things, but not anymore to the same degree, certainly, as was common, I think, earlier in my career. I think the thing that was the hardest, though, was there is this kind of double standard, right? That a woman who's assertive and confident and competitive is just branded with terms that, you don't want to say in polite company. And whereas a male who has exhibits those same characteristics is trumpeted as a leader and as someone that folks want to follow. And I can remember many times throughout my career, having some of those, what I thought were positive qualities, being used against me as reasons why I was not leader-like. And so I worked really hard on trying to conform or address some of those, rub out the rough edges or whatever you want to call it. But at the end, you have to be you. And I guess maybe the industry's finally caught up with me, or maybe State Street's just the right culture, or maybe I have softened a bit around the edges. But the good news is that ultimately I've been able to achieve, some great success in my industry. And I think, hard work, resiliency, being prepared, like all the things that women do naturally, right? We're super prepared, we're super smart, we're super resilient, we're super adaptive. I think all those things did well for me during those periods when I might otherwise have sort of crumpled under the weight.
Yeah. No, I totally sympathize with you. When I started in trading many years ago, I started in London, and we had 44 people in the room, 44 traders, and it was 43 men and me. And
yeah, so you probably got asked to get a lot of coffee too.
There was a lot of, I didn't know when they were saying it, but in trading, when things get heated and people start to a little bit use bad language, they weren't sure they're supposed to use bad language in front of me. Can they use a 4-letter word?
You just throw it right back at them.
Absolutely. And once they get that, then it's perfectly fine. And but we've come a long way, so that's great. So another question, I'm really interested, speaking of traders and so forth. When COVID hit last year, I mean, you guys are trading billions of dollars every day. Mm-hmm. How in the world did you move from a completely being close to each other trading desk environment to completely remote and still, not miss a beep? I'm really curious how that works in the trading environment.
Well, first of all, I think we still marvel at it ourselves. And it was not just the trading desk, but literally the entirety of our global staff went from being, in a more traditional office environment to working from home over a matter of, a few days. So it was really nothing short of remarkable. I think there are a couple things. First of all, we put in place a lot of different playbooks post-global financial crisis for all manner of things, whether it was, understanding better our exposures, risk tools, other kinds of portfolio tools, trading technologies. There were a variety of things, some of which were in direct response to the global financial crisis, and some of which were just sort of the normal building a more resilient operating model over time. So we were quite fortunate that in some sense we'd had a decade to prepare, although it still didn't feel like that. The other thing that was serendipitous, although again, not necessarily in a good way, is that you'll recall that there were terrible riots in Hong Kong in 2019. And we have a sizable trading operation there. And so we had to very quickly mobilize in the region to get all of our staff able to work from home. And that gave us a bit of a beta test, if you will, of anything else that was a loose end, whether it was the actual systems that people were using, the hardware, the software, any kind of compliance or oversight kinds of issues that came into play, any kind of regulatory challenges, reporting. So there was a whole bunch of stuff that we had to kind of mobilize very, very quickly in relation to the Hong Kong situation that, again, gave us a really good playbook and readiness so that, when the pandemic did hit with full force, we were able to get ourselves oriented. And we obviously always have disaster recovery sites. We have, redundancy, but we were able to leverage some version of people remaining in the office as appropriate, some version of people in redundant work sites, and most of the people working remotely from home. And because we had, like I said, done that groundwork and had the sort of, scramble with the Hong Kong riots, we were incredibly well prepared, I think beyond our wildest imagination.
And you had no idea at that time that this would serve you well.
Well, we had no idea that it would be for over a year.
Wow.
And our friends in Hong Kong, have been basically working from a remote location for 18 months now. So, and again, we do have people who periodically go into the office. So we do have the platform, and we've got social distancing, and you have to be invited back to work. People aren't required to go back to the office, et cetera. So we have all those kinds of provisions in place. But if you'd have, told me a year ago we'd still be operating this kind of environment, I would have been, I would have said, please no, please no. And yet here we are, and we're dealing.
That's amazing.
Literally, we're dealing.
Yeah. That's really quite a task. So speaking of risk factors, are there any other things that are totally beyond your control that you're concerned about as a manager of this amazing amount of money?
Yeah.
Is it, I don't know, a trader's poor judgment, or whatever, or could be a lot of different compliance issues, or could be, I don't know, climate change, or things that you cannot control? What's
Well, all of the above, of course. I think that there are a couple things. First of all, when you have the kinds of volatility episodes that we saw at the end of March and early April, even there's no margin for error, like literally. If you miss a trade, or you fat finger a trade, or something like that, the consequences can be monumental. I mean, think about some of our portfolio strategies are multiple hundreds of billions of dollars. And so we can't afford any errors, because if we have an error, it can be devastating, especially in an environment like that. So that's always going to keep me up at night, because you worry about that, one time when a trade doesn't get entered, or you don't get the communication or whatever. So we try to do lots of things to create resiliency and redundancy in our system and whatnot to avoid that. So those are the things that we kind of can control, but if we don't, then they're really, really dramatic. And then you have the big ones like cyber. I mean, the whole cybersecurity thing. Again, we as a company writ large invest millions and millions and millions of dollars in managing against these threats. And I've seen some statistics that are just mind-boggling in terms of the number of assaults we get on a daily basis that we detect and we manage against. But all it takes is one to get through. And here again, it can be kind of devastating for the business. And then you have, like we talked about earlier, you have the bad actors on the stage. All it takes again is one bad actor doing one really bad thing, and all of a sudden game over. And then the last thing I would say, and kind of going back to our non-fungible tokens and cryptos, and you didn't mention GameStop as another meme, but in and of themselves, some of those places aren't particularly concerning. They're signs of excess, and I dare say bubbles. But they also do have the ability to destabilize, especially if you get contagion. You start to get like an Archegos, spilling over into the banking sector, and all of a sudden, then you kind of find yourself back in that 2008 moment where you're not sure sort of where the bodies are buried. So that's the other kind of, I think, big systemic risk that we all face.
Yeah. I mean, speaking of Archegos, I mean, we thought that after 2008, 2009 and Lehman and so forth, we had so many controls in place, and, but it seems there's always something new, and that a company like Credit Suisse got caught so badly in this latest things, and lots of heads are rolling or have rolled, and perhaps will continue to roll.
Yeah, it's like the history just keeps rhyming, So we all think that we've got everything under control, and here Okay, it wasn't, if it had been a hedge fund, everything would have been fine, but it wasn't. It was a family office. So that changed the
Yeah.
nature of the discovery and the relationship. And there you go. So
Yeah.
it's hard to plan for every eventuality. You need good judgment, you need good risk
Yeah.
control, and you need good oversight.
Yeah. Great. So we're almost out of time. So here I'm just trying to combine a couple of our questions that have come in. What do you see as the long-lasting effects after COVID on trade activities or anything else that we haven't covered yet? Do we see a hybrid model, how we will do business with each other globally?
Look, I think that COVID has accelerated a number of trends. I mean, adoption of technology, for example. I mean, we were a big believer in, technology infusing, life more than it had before, and we saw that sort of play out pretty dramatically during COVID. So that's one that's probably with us. I think this other idea of the more regional alliances versus global. I mean, even we look at our own business. I mean, once upon a time, we would track towards a business model where we might have like one center of excellence doing a particular kind of activity. And in the face of COVID, you say, well, does that make sense? Or do you need a certain amount of redundancy? So thinking about your supply chains a little bit differently. I think client engagement, the people are more willing to have these kinds of virtual conferences or conduct business in a virtual way. So I think there are a number of things like that. And then, certainly the next scare will be a different kind of scare, but I think for a while, behavior patterns, it remains to be seen what the long-term behavior patterns are likely to be. Certainly, this is not a multi-year event yet. Hopefully it doesn't become one, but you think about the depression mentality of people who lived through, a decade of that kind of economic backdrop. I don't think we're going to face that. Hopefully there's not long COVID in the economy. But one could envisage that behavior patterns take a little while to go back to something called normal.
Yeah, absolutely. So lastly, final question before we have to sign off here. Since you're talking, I'm sure you spend a lot of time every day talking to some of your major clients. Is there anything else that the questions that you hear all the time that we haven't covered yet? Is there anything else that we should pay attention?
Yeah, I mean, look, I think the big one is the I question, right? The inflation risk. Is all of this monetary and fiscal policy ultimately inflationary? And, certainly the conditions are building for that. We're not in the camp that suggests that we're going to see a lot of massive global inflation. However, a lot is resting on the ability of primarily monetary policymakers to exit the current accommodative policymaking with aplomb. And when you layer into that, massive fiscal stimulus, depending upon the complexion of that, that's a story that we may be talking about in a year if things kind of go in a certain direction. So inflation, I think, is one to also keep an eye on for the future.
Yeah. Okay. Very good. Excellent. So I think we are at the end of our time. And so thank you, Lori. This was really, really fabulous. Thank you so much for spending the time with us. And before we go, I'm supposed to tell everyone and invite everyone on May 20th at 4 p.m. will be a social networking cocktail with the co-founders. So please put that on your calendar and sign up. And should be a fun, different event. So thank you, everyone. And we look forward to everyone's continued engagement. So thank you, Lori, again, very much. And thank you, everyone, for tuning in.